The RBI has proposed its most comprehensive set of guidelines ever on project financing in the country. The move may decisively change the way infrastructure and real estate companies fund their projects through debt and how banks lend to them. Okay, so what are the new rules? Well, whenever banks give loans, they set aside some money ahead of time to compensate for losses. That is, the part of loans that they may not be able to recover. This is called provisioning. Banks currently provide for 0.4% to 1% of long-term project-backed loans, depending on whether they're financing roads, airports, or power plants, a commercial real estate project like, say, a corporate office park, or a housing complex. Now, the central bank has proposed that the loan provisions on all of these should be increased to one single rate of 5%. Why has the RBI done it? For higher, time-bound accountability and increased viability of projects. In March this year, the Ministry of Statistics and Program Implementation did a comprehensive status check on 1,873 projects across the country. The projects, spanning segments such as railways, highways, power, petroleum, coal and steel mines, and defense, were worth 31 lakh crore or 31 trillion rupees. The results of the status check were quite stunning. A total of 779 projects, or 42% of the total, were delayed, and 449, or almost a quarter, faced cost overruns of over 5 lakh crore rupees. The new rules are to avoid all this. So basically, the RBI does not want a project to give rise to something called a credit event, which means a default on loan payments or a delay in the project beyond its promised completion time or additional debt or diminution in its value. Now, stakeholders have until June 15 to comment on the draft guidelines, but they have already created a massive stir in banking circles and among companies implementing and planning large projects. Some have even reached out to the RBI, appealing to it to lessen the provisions. Why? Because for banks, the higher provision directly hits their profit and loss and net worth. And for infrastructure companies, it may lead to higher cost of capital, higher by as much as 1%, which could mean thousands of crores, especially for mega projects. So, are the RBI's new norms beneficial or are they baleful? Let's find out. It's Thursday, the 23rd of May. From the Economic Times, I'm your host Anirban Chaudhary. This is the Morning Brief. Let's understand the broad numbers first. Here's Anil Gupta, Head of Financial Sector Ratings at ICRA, explaining to me the total exposure that Indian banks have to infrastructure projects in the country and the actual impact that the proposed norms may have on them.
The figure is that of the total infrastructure projects, under construction projects are close to 25% of their loan portfolio. If you have to look at the bank level kind of exposure which is there to the infrastructure sector, so if you look at the bank exposure, that bank exposure will be close to 12 lakh crores. So that 12 lakh crores is spread across maybe power sector at 6.5 lakh crores, telecom sector at around 1.5 lakh crores, roads at around 3 lakh crores, and then other segments of the infra. So total banking sector exposure will be around 12 lakh crores. So as such, it appears that if you have to go by this number, let's say for banks, which is 12 lakh crores, of which, let's say, at an industry level, 25% exposure is towards under construction projects. So roughly 4 lakh crores is the number which comes in terms of exposure, let's say, which the banks potentially could have in terms of under construction projects. So I have to put a 5% provision towards this. So roughly around 20,000 crores will be the additional provisioning requirement which can potentially kick in. Now, is this 20,000 crores of additional provision a very large number? If I have to just put it into perspective, so the operating profits of the banks in FY24 will be upwards of 3 lakh crores. So 3 lakh crores is the operating profit number. And if I have to look at their capital number, the capital number will be somewhere around upwards of 15 lakh crores. So that way, vis-a-vis the profits and the capital, the number is not very large in terms of the ask for the provision. They will be possibly be required to possibly recover the cost of capital through some increase in the lending rates, and especially during the construction period, because the construction period is the time frame during which that additional provisioning is required. Now, we have estimated that the impact of this additional provisioning could lead to maybe additional cost of capital, which is 20 to 40 basis point for a lender, especially during the construction period.
So, what was the RBI's thought process that went into drafting these rules? I asked my colleague and ET's banking ace, Sangeeta Mehta.
So broadly, from whatever sense that we get talking to stakeholders such as regulators, rating agencies, corporates, banks, is that there was sort of exuberance in not just lending to infrastructure commercial projects, but also among corporates. So I think what RBI probably wanted was to moderate that. And if you go back to past also, when there was excessive lending to NBFCs, RBI has imposed higher provisioning norms. When there was huge growth in credit card business or credit card borrowing through credit card, RBI has increased provisioning norms. So this is what normally RBI does when they see exuberance. They impose these provisioning norms generally. But in this particular case, probably it was long called for. But the other thing is, which could be the main reason why RBI did this, is pricing of loans. You see, as things stand, banks aren't pricing the risk that is involved in funding an infrastructure project or commercial real estate or any project. That is the best rated corporates can raise money at less than 10%, between 9.5% and 10%. Now, that probably is a concern because the risk is highest during the construction period. And if your rate continues to be 9.5%, 10% during construction period, post construction period, it just doesn't make sense. And usually post construction, most of the corporates, they actually close the loan and move on to other lenders, or they borrow overseas. They actually kind of move out. So like SBI chairman, he said in a recent press conference that the risk was not properly priced, and that probably is RBI's concern, and that may have led RBI to come out with these higher provisioning norms. And this probably RBI is hoping that if banks have to make a higher provision during the time of construction, that cost would be passed on to the borrower, and probably that will kind of negate this risk of improper or mispricing which is there in the system.
So, Sangeeta, let's talk about who will be impacted by these guidelines.
Anirban, actually everybody. Of course, the borrower will be impacted because eventually his cost of funding will go up. A lot of projects that you see now are probably initiatives taken by state, and he might probably have a lesser appetite to bid for them. So that is one. For lenders, this would mean that if they are not able to pass on the higher provisioning to the borrower, it means that their earnings will come down. This also means that their capital requirement will go up because you have to make higher provisions. Plus, overall, I think it has kind of cautioned a lot of players that, this is not something that RBI is very happy with. So it kind of sets ball rolling for rethinking of how do we go about, or how do we overcome the new regulations and yet be in the business.
Will this mean that lenders will now charge higher rate of interests on such loans? And of course, particularly at a time when there is a talk that RBI may actually cut rates by the end of this fiscal year, or say early next year.
So technically, banks can hike rates for projects. But I think it's unlikely that they will hike interest rates or pass on the higher impact for all borrowers, because this is like hiking rates midway through the construction period. And people may say that, when you hike rates midway, the project may become unviable. Or it may even happen that the borrower may negotiate rates with some other lender. So, given the intense competition and relationship that the bank may want to maintain with the borrower, it is unlikely that they will hike the rates midway through the project.
So, Sangeeta, some banks have already asked the RBI for a relaxation. What do you think the central bank will do? Will it make a U-turn?
There is no way that RBI will do a full U-turn, and there is no way that RBI will probably reduce the provisioning norms sharply. But there could be some tinkering in this. Now, June 15th is the day when they have to, all banks have been asked to give their response to RBI in a particular format. How much will be the impact, to what is their current provision which they have set aside, and how much is the additional that they may require to do if these guidelines are on as is whereas basis. So it's something which we'll get to know, but most likely banks will lobby very hard.
So, Sangeeta, coming to the other side, how will things change for infrastructure companies that are looking to set up huge projects or are in the process of setting up huge projects? What will they have to take care of while they're planning to finance those projects?
See, the earlier guideline said that the construction period can go as much as 4 years. So if you said that you'll complete it in 3 years, you can take an extension up to 4 years. So you can go up to 7 years in all. But now what RBI is saying is that if you have said that you will complete the project in 3 years, you can get an extension of another 3 years. That's it. Which in other words mean that when a company goes to a bank with a proposal to raise money for any project, leave aside infrastructure, any project, he should be crystal clear that it will be over within that time frame, and they should get all the approvals ready for it. Now it's very difficult to be crystal clear in the beginning of, because there are a lot of policy changes that government itself keeps coming up with. But they will have to have at least what RBI says 50% of the land in their possession. They have given a full checklist of things that should be in place. And what RBI has said that if the project then gets delayed and it requires banks to put in more money to revive it, give additional money as debt, that particular project cannot be deemed as standard. Within 30 days, you have to take a decision to restructure the loan, which alternatively means otherwise take it to NCLT if you can't do that in 30 days. And if you have decided to restructure the loan, within 180 days, it has to be restructured. Approvals has to be in place to restructure it. So that is what is going to be an implication. And RBI has also said that moratorium cannot then go on beyond 6 months from the, so if you're saying that I will complete it in 3 years, my project, and you complete it in 4 years, let's say, so that's fine because, they're giving you time up to 3 years for infrastructure projects. But then after that, your moratorium can be only 6 months. You cannot have 1 year and 2 year moratorium after that. So the cash flow has to start to banks after 6 months.
From your land acquisition to the completion of your project to your cash flow, everything becomes more stringent for infrastructure companies because of these guidelines.
Yes, and it becomes more time bound.
Correct.
So that is one thing which RBI is more clear about, that it should be done in a way that you have a clear idea when you're going to get the cash flows.
The big names in the infrastructure sector are, of course, hailing the RBI's proposed guidelines. Here's L&T CFO Shankar Raman in a recent media interview.
It's very responsible of the central government regulator, Reserve Bank of India, to keep goading the lending system, the financial institutions, to actually take a lot of diligence and care in choosing the projects where funds have to be lent. We've had enormous instances where the projects were awarded to less than capable contractors. The projects were never completed. Even if they are completed with cost and time overrun. And that locked in more of the bank resources. So my own take on this is Reserve Bank has given the right signal by telling the lenders that please back projects which are capable of completion within cost, within time. What that means is the financial institutions, like the global financial institutions too. The global financial institutions pay a lot of attention to the vendors and supply chain partners. They go into details as to who are the people who are going to help complete the project. The Indian financial institution in the past used to go a lot on trust but verify mode, where the project sponsor gets evaluated, and if that person is competent, if the institution is competent, the rest was supposed to be taken care by the project sponsor. Whereas the financial institutions now will be forced to look at who are the components who are going to deliver to the project. And to that extent, that's a good step towards improving quality. But the short near-term effect of that would be some more rationing of resources. So I think it augurs well on a broader scale. And maybe over a year or two, this will settle down, and India needs good projects. And it needs projects which will be valuable for its own economic purpose. And this move, in my opinion, will support that.
But there are critiques too. Here's Shravan Sampath, a renewable energy sector professional with 18 years of industry experience with companies such as Reliance, Equis Funds Group, Oak Ridge Energy, and Brookfield.
I think there is no two ways about the broader direction of this, which is that banks need to be prudent in terms of lending to infrastructure projects, which could be at times fraught with uncertainties. But there is a major concern here about the timing of these RBI guidelines and the way and the broader global context. So, to begin with, the big problem is that already interest rates are very high, both in India and around the world. So, at this point in time, increasing provisioning to 5% basically means that the interest rates can go up anywhere from 0.7% to 1%, which, and as we know, infrastructure projects are typically debt financed, 70 to 75%. And therefore, these projects will have a major issue in terms of obtaining the kind of target returns. And effectively, what will happen is that the developers will need to increase their equity threshold in order to compensate for this increased cost of debt. And all of this will only result in higher tariff to the customer. Now, is that what we want in a country like India, which is, politically at a time where we're looking for cheap power tariffs? A lot of power is now being committed for free to customers. Is this the time that we should look for high rates of power because of this? That's the broader context. The other couple of issues around something like this is the capping on moratorium. So there's a clear capping on moratorium of 6 months, which is a problem for infrastructure projects as well, because we have been getting moratoriums of up to 1 year. Typically in renewable projects and early stage infrastructure projects like road projects, the first year is a stabilization period. So the moratorium, when it goes down to 6 months, that stabilization period gets hit, which means that as equity investors, there'll be a lot more caution and there'll be a lot more, prudence exercised in terms of making more cushions for repayment within the 6 months that is now not being provided as moratorium. That's the second one. And the third, of course, as we know, is the deferment of commercial operations date is being allowed only till 3 years, which basically means that if your commercial operations date was, let us say, end of this year, it cannot be deferred by more than 3 years. Now, this is not an issue that will affect renewable energy, for instance, but there are a lot of other infrastructure asset classes where their delays are endemic because of land acquisition issues, because of environment issues, forest issues, etc., etc. So these asset classes would get affected. And as luck would have it, these are some of the asset classes which are very important for India's development today. For instance, hydro projects. We've not had any greenfield hydro project development for almost 7-8 years now. And the government is looking to kickstart hydro project development in a big way. So at this point in time, having these sort of restricting this would create disincentives for people to enter high risk and slightly more long gestation infrastructure projects.
Now, recent reports quoted Finance Minister Nirmala Sitharaman as saying that banks should focus only on core banking and there are other institutions that will take care of project finance. I asked Sangeeta what she makes of it.
Actually, this is very interesting because it's become a talking point among banks. When there's a strong comment like this coming from Nirmala Sitharaman, probably it means that government seems to be fine with the RBI guideline that banks should move out of infrastructure financing, and banks are hoping that finance ministry might intervene and actually ask RBI directly, indirectly to reduce provisioning. But here the FM comes and says that why should banks do project financing when we have specialized institutions, and we have not just NAFED, but we also have PFC and REC. And PFC and REC are no longer mandated to give loans only for power finance, but now they've been given Maharatna status, which means they can actually give loans for roads, ports, other infrastructure projects. Now, then you have IIFCI. So probably what he was hinting at is that banks should either accept it as it is or move on and do core banking, which probably means retail financing, agriculture financing, small businesses, you finance them. So probably it means that the relaxation might not be as much as banks are hoping for, because she doesn't seem to be showing any signs of indicating that that we may step in and talk to RBI.
And finally, I asked Anil if this is also, as many critique some of RBI's recent moves, a case of throwing the baby with the bathwater. After all, India's infrastructure story is booming. The latest budgetary outlay of infrastructure-related ministries increased to 5 lakh crore rupees from 3.7 lakh crore rupees the previous year. Will that story be derailed?
No, I think this is maybe something which is an initial reaction from the lenders. So every time there is a ask in terms of higher risk weight, higher provisioning requirement, which has an impact on the capital or profitability. For example, let's say in November 2023, when RBI increased the risk weight on the unsecured loans or lending to NBFCs, right? So there was maybe some kind of a reaction that this is quite stringent, right? But we should look these actions from the regulator in the spirit of maybe strengthening of the financial sector and not as a short-term reaction. I think it should not have a change, because infra financing, let's say today we are in an interest rate environment which is much lower than maybe what used to prevail 10 years back, right? So even 5 years back, pre-COVID, the interest rates on lending or loans were higher than what they are today. And the access to the capital markets, the foreign markets, foreign funding, that has improved only, right? That way, the funding environment is relatively better what used to be a decade back. And as such, given our funding requirement or the need to scale up the infra, the demand will always remain, right? We have a lot of maybe pipeline in terms of infrastructure projects. So funding demand will be there. There'll be some impact in the near term in terms of funding rates and funding costs. But as such, it should not derail the overall, maybe the growth story in the infrastructure sector.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Vinayak Agarwal and sound designed by Rajas Naik. Do like, share and subscribe to TMB. A new episode of The Morning Brief drops every Tuesday to Friday on a listening platform of your choice. Thank you and have a good week.